Hello, Happy New Year, and welcome to the 2026 property market predictions. This is the sixth year that we've been publishing our property market predictions. And this year, we're going to set you up to understand exactly what's going to happen in the market, the economy, and what to do when you're looking at your deals as far as things go like property prices, interest rates, inflation, all of these key metrics that we really need to know and understand if we're going to move aggressively into 2026 and capitalize. Over the last 5 years or so, we've shared these predictions. And if you wanted to go back and listen to last year's predictions, it was actually the #1 listened to podcast in 2025. You can go back and listen to that and you'll hear what we predicted a year ago. Off the back of that, we've gone out and completed on a number of portfolios, blocks, commercial properties. We've bought a hotel, a nightclub, some development deals, blocks of apartments. And all of those together was based on the results from those totaled together over £4 million in net returns on all the different business and property deals we did. And they were purely based on the forecast that we published last January. So I'm going to take you through this. And if you want to hear last year's to get confidence of how well you can actually execute this in practice when you understand it, I'd highly recommend that. Equally, if you wanted to hear the deals that we did in 2025, listen to last year's predictions. Then on the 1st of January, Thursday the 1st of January this year, we recorded the Deals 2025 in review. And on there, I shared some of the property deals that we did that contributed towards that £4 million net gain last year. So you can listen to that in addition. And the objective of this podcast episode is to take you through the motions to understand how the economy works, what the key metrics are going into 2026, and what you need to do if you actually want to capitalize in this market. So there's 2 points to note when we're doing these predictions, and this is a lot about the economy and psychology. The first thing is if you read the newspapers, if you don't read the news, you are uninformed. And if you do read the news, you are misinformed. And the reason for this is the headlines are there to sell papers and basically scare people. And the more bad news you see, the more good news that is for you, because you can go out there and actually do deals whilst all your competition are running for the hills. And what I've noticed recently is actually a lot of the stuff in the press, not only is it misinforming, it's also turning a lot more political than it is economical. And there's a lot of conflict, challenge, just noise around national, global politics, and a lot less about the economy. Really, for the economy, we want to be seeing public sector saving. We didn't see much of that in the budget, and we want to see stimulus for business and entrepreneurship. As of yet, we're still not seeing a huge amount of that. So the first thing is don't read the newspaper. You want to be following the market and the economy based on the stats, not the sentiment. And the sentiment is the headlines that sell the papers. So the first thing is don't listen to the news. The second thing is human tendency and psychology. History never repeats itself, but humans always do. And this is when you read about economics, you understand psychology, things like reflexivity. When you've been through a number of economic cycles, a number of markets life cycles, a number of recessions, what you start to notice is a lot of this stuff is very predictable. It's not necessarily predictable down to the day, month, or even year, but the general concept of the cycle is very, very predictable. And humans just act in the same way, whether you're talking about crypto, you're talking about business, or in this scenario, you're talking about property. It's all very, very predictable. When we look back to last year, and you'll see this on the 2025 predictions, if you go and listen to that, when I talked about what to expect from the market, that pretty much rung true. I'll go through that in a moment. The concept that we sort of hedged our bets on last year was that the economy was like driving in the fog. And what I mean by this is it's completely safe to leave your house and go out in your car and drive down the road. You can see ahead of you enough to be able to drive at a safe speed, but visibility is quite limited. And because of this, we can't see too far ahead. And this is what the economy was like last year. We knew that in the short term, the next like 3, 6, 9, maybe 12 months were reasonably predictable and baked in. We could see where we were going. but we really wouldn't have the confidence to put our foot down in the fog and race 100 miles an hour because we didn't know ahead if it was going to be a roundabout, a left, a right, or a cliff edge. And that was like the economy. So all the deals we did last year, we were basically looking to get in and out quickly. And on recent podcast episodes, you will have heard me talk about deals I've done where I've made 100, 200, even 500,000 pounds on deals that I've been in and out of in 90 days. And some of the bigger buildings, the blocks, the portfolios, where we were genuinely making 7 figures or more from a deal in less than 12 months. And in some cases in only owning the properties for actually 6 months. So we were driving in the fog, getting in and getting out, and definitely not doing things like build to sell developments. At the beginning of the year, or even 2 years ago, we said that would be a dangerous situation. Sentiment stands. That turned out to be the case. And that fog was, restricting us from going anywhere. If we look at the key metrics from last year, so if we look at inflation, we predicted that inflation would either stay steady or there'd be a bit of a push up. On that, we were loosely accurate. What we didn't anticipate was the big spike in running costs, especially for the mass market, minimum wage, national insurance, etc. That obviously created a bit more inflation than we expected. Interest rates, while at the beginning of the year, people were expecting a 1.5% to 2.5% drop. We predicted in the October of the previous year that would only drop 1%. We were pretty much, in fact, we were absolutely bang on. It only dropped 1%. Mortgage rates, we said, would fall steadily in line with that, but nothing more aggressive. That's exactly what we ended up with. Property prices, we said we would then have what we called a spring ping, where there would be a big jump in property prices. We predicted that would happen in April. It absolutely did happen, but it actually happened in January and February, so about 3 months earlier than we anticipated, but it absolutely happened. GDP, we said, would tick up and down, but not really go anywhere. It would just pretty much flatline. It's exactly what happened. And we said that rents would absolutely go through the roof like a rocket. And 12 months later, you look at where rents are now, absolutely, bang on the money. It was like a rocket, went through the roof. Like I said, if you want to hear the deals that we did last year, between the business and property deals that we did based on that economic forecast, all of those strategies and decisions were made around the market model, which is what we basically carve in stone at the beginning of the year and then deliver our strategies against. And off the back of that, we achieved a net return of over £4 million in 2025. And if you want to hear the deals that I did that contributed towards that, go back to the podcast episode that was released on Thursday, the 1st of January, Deals 2025 in review. And I take you through all of the deals that I did in that podcast. So looking towards this year, so if we're going to predict what happens in the economy this year, and this is what I'm going to do now, this is my 6th year of doing this. And the last 3 years, we've shared these publicly on the podcast and in the open market and at speaking events. The 3 years before that, we only ever did it behind the scenes, supporting our property entrepreneurs. And this really is why our members stay for so long. We've got property entrepreneur members who've been with us for nearly a decade. And bearing in mind, our programs start at £10,000, £15,000 a year and go up to £40,000 a year. That's a significant time investment, a whole year, and money investment in obviously choosing which community to be part of. And our 200 paying members, year in, year out, come back to learn this model. And then every month we show them how to execute in practice with the more micro elements of sourcing deals, stacking deals, negotiating leases, understanding the market when things move, as they will through the year, how to pivot and adjust, and really how to capitalize on the business. So I'm going to take you through this now to give you a good understanding of what's happening in the market. And the model that we teach on Property Entrepreneur is called Master the Market. And we do it pretty much every month, mentoring our clients daily, weekly and monthly on what to do, when to do it, giving them all the resources they need and how to actually execute it in practice. And when you understand this Master the Market, you will make more deals than all of your competition. You will manage the risk of being in property and an uncertain market better than anybody else. And the net result over a number of months and years doing this is the money that you make and the portfolio you build and the wealth that you actually create and establish will be significantly higher than it was if you did it in the way that everybody else is. Because mastering the market is a very niche skill. And what we're looking for is observing the masses, doing the opposite, and finding the bits of the market which nobody else understands. So I'm going to take you through this so you can understand the economy and how we've built our model this year. The first thing to note is that the UK is dying. Now, it doesn't matter whether you look at this quantitatively or qualitatively, every data set is pretty much a downward trend in the UK. That's not fantastic for business. And then qualitatively, all you've got to do is drive around, and whether it's driving around and the quality of the roads have got potholes, or you walk around a city centre and it's the volume of people that are just not there anymore. You look at the quality of the high street, the shopping centres. A lot what used to be a thriving area of maybe bars and restaurants is now charity shops, barber shops, vape shops. The amount of people that have fallen into homelessness in the UK is starting to increase. A lot of the antisocial behaviour in some areas is getting worse. And you just walk around areas that perhaps used to be in previous years or decades thriving, and actually just wonder what's happened to that buzz, what's happened to that energy, that drive, that active economy where people were, growing, businesses were investing. There was a hype and an energy about it. A lot of it now, especially in the big cities, less so in the rural areas, you just look at it and it looks like an economy that is on a downward trend. And you're going to see that more and more with increasing unemployment, businesses closing down, retail, hospitality under complete pressure. Not only that, sort of qualitatively and quantitatively, but also when you think about society. The society in the UK pre-COVID, post-global financial crisis, 07, 08, especially rocketed during the pandemic, and then a lot of social changes over the last decade or so. 24 up to the last set of stats that I've got, 24.8% of working age population in the UK are actually out of work. So nearly a quarter of people who could be working in the UK are actually not working. 21.1% of those which is 9 million people, are economically inactive, and 3.7%, which has now gone up to 5% because we've got other people coming through the workforce, people actually coming back, are actually unemployed. So there's a lot of people that are arguably, and this doesn't apply to everybody, but there are some people who are not working when perhaps they could. And if you think about the reduction of value that adds to the economy, but also the pressure that it puts on the social state and the welfare state and the cost base of just keeping the economy going, that's not traditionally good for business. You look at growing economies and how big their welfare state is compared to a lot of the developed countries now, specifically UK and some other European countries. That welfare state is very large, and the UK is significant. When you look at that as a percentage, what does that actually mean in practice? Well, this is even more sort of shocking when you're looking at the UK economy and trying to forecast what's going to happen in the year ahead. For the last 3 years, 22, 23, 24, and we haven't got the 25 figures yet. So for the last 3 going into 4 years, the percentage of people in the UK living in households that were net recipients of the tax system was over 50%. So in 2022, it was 53.4, 23 was 52.6, 24 was 53.3, and 25 will be released soon. What that means is over half of the population of the UK are net beneficiaries. It means they take more out of the tax system than they pay in. Now, just think about that as a business. If your business had X amount of clients and over 50% of the clients was costing your business money, you think about that pressure it puts on your ability to grow, to service the good clients, to invest in actually a sustainable trajectory to actually take your company forward. Over half of the people that are in the population and half of the people that are buying from your company are actually costing you money. They're taking more out than they put in. That's not good for business. Running parallel to that, productivity. If you look at productivity in the UK, it doesn't matter which data set you look at. You go back to 07, 08, and it's just flatlined. You're coming up to a decade of flatlining productivity in the UK, and we're now running behind a lot of the global countries and economies who are just overtaking us because our productivity is not there. And you just, again, quantitatively, you look at the stats, it doesn't matter which data set you look at, productivity is flatlining. And it has done since 07, 08. In practice, what does that mean? I mean, I spend a lot of time being driven. So I've got I will work in the back of my car because I've got drivers who will take me places. The majority of the time I'm trying to work in the back of my car, I can't even get signal on my phone or my laptops enable me to do work on a lot of the main motorways. Go into London or Nottingham city centres, town centres, central London, central Nottingham, where I spend a lot of time. It's quite frequent. You can't get a good internet connection. These are the basics. You go to other countries, the poverty-stricken beaches of Thailand, and you can get 5G internet and do video FaceTime. You can now get Starlink when you're 25, 30,000 feet in the air. But the UK economy, we're just flatlining on that productivity. The impact on GDP, it doesn't matter what data set you look at again, it's a little bit up, it's a little bit down. By definition, it could be there or thereabouts in and out of recession the whole time. But the reality is it's just not going anywhere. Yes, it's been resilient, which is great. For whatever reason, it's managed to protect itself through the pandemic, double-digit inflation, spike in interest rates. Unemployment hasn't spiked aggressively. The economy's kept moving. There hasn't been a big cliff edge yet. But equally, it's just sort of flatlining. It's not really going anywhere. You then look at global economies. Now, the UK, since the early 1800s, has been in the top 5. Bear in mind, we're only a small island, but we've got global reach, and we used to be a powerhouse for a lot of sectors. The UK economy, for over 200 years, has been in the top 5. In the last 12 months, we've fallen out of the top 5, and now we're wrestling 6th and 7th place with France. This is not a good sign for the UK economy. And when we talk about it's dying, it's not falling off a cliff and it's not in intensive care, but it is you look at it and you just think, these are not the sort of things you want to look at. These are not the things that you see. And when you start looking at other data sets, so for example, average weekly wages, when you adjust them for inflation, again, they've just flatlined since 07, 08. Before that, the general trend and trajectory was up, which is exactly what you'd want for a growing economy. But since then, it's just flatlined. And when we're trying to predict what to do in the next 6 months, 12 months, what's the Bank of England going to do with rates? What's going to happen to inflation? What's going to happen with GDP? All of this starts to paint a picture which becomes really clear. And the reason that we've been able to predict the economy over the last 6 years enough to go and do deals is because success and failure with it are very predictable. And when you look at this sort of stuff, these aren't things that are changing overnight. It's not like a shock, like a global financial crisis or like a COVID or a lockdown or a pandemic or a recession. They're just solid data sets that are all heading in the same direction. And it's this that impacts what happens to the economy statistically. When you then look at it by sentiment and by basically reflexivity, how people are behaving and what they're seeing, people are still getting pay rises every year. So they're thinking, this is great. This is actually working quite well. They're buying nowadays from companies like Temu or Shein, and they're getting pallets or bags of clothes delivered for what previously you wouldn't even get a designer jumper for. And they're having this arbitrage where actually life still seems pretty good. Pay rises every year. You're getting clothes delivered in, bag loads because they're so cheap. It's a little bit of a distraction from what's actually happening because interest rates, if you think of most people who were born in the 80s and 90s, they've grown up on low interest rates, bottomed out interest rates where everything's been cheap. Overdrafts, credit cards, help to buy mortgages, debt has just been low, car finance, and they've been living the dream. But if you look since 2022, that's just gone up aggressively. And actually what was a bit of a fantasy land has now disappeared. And the real term disposable income, the impact that's having, and again, this is not a new trend. This has happened since 07, 08, but with increasing inflation, slowing wage growth, and reduced disposable income, again, it doesn't matter what data set you look at, that middle market, that mass market in the middle, you used to have the poor and the wealthy. The mass market in the middle, which is the majority of people, they're really starting to feel the pinch. And if you look at the disposable income now in the UK, citizens of the UK by disposable income have less income than all 5 of the US's poorest states. So you take the 5 poorest states in America, they all have a higher disposable income than the UK. And the people in the UK in that mass market who've grown up on zero interest, they could have whatever they wanted. They had help to buy new build home. They had 2 brand new leased cars on the drive, 2 family holidays a year, out for dinner 2 or 3 times a week. All of this sort of great lifestyle people have had for the last decade or so. they're really now starting to feel the pinch. And if you look at the difference between the annual salary and the UK average house price, that gap between how many times salary it used to be to buy a house and what it is now, that gap is just growing exponentially. And when you look at the affordability of this in recent years, over the long term, the average is about, when you look at, again, most sort of broad stroke averages and indicators of where is a well-functioning economy and what's the balance of affordability, all things considered at a macro level, the affordability to buy a new home, the sweet spot is about 4 to 5 times income. That's where you want it to be. Looking at the most recent data sets, that's been crawling up since 03, 04, spiking in 07 at sort of 7.76, falling back down over the global financial crisis. But then since 2016, it's been going up and up and up. And the average UK salary now versus the average UK property price, bearing in mind the average for a good, stable, balanced economy would be 4 to 5 times income. The average house price is 8.4 times the average income in the UK. That's just not in the scheme of things. Again, you look where it's got to, that's right at the end of the range of where you'd ever want it to be. It's well above the average. And that's for people who buy houses. Obviously, a lot more people now are just renting. And again, the balance of sort of broad stroke affordability is defined as 30% of your annual income or monthly income covers all of your housing needs. Now, if you look at rents in the UK, the average rent in the UK is now 32.5% of salary. So for it to be affordable, it should be 30% of your salary on rent and bills and overheads and everything to do with your house. Rent alone now is 32%. By the time you've put on expensive gas, electricity, council tax, household bills, the reality of people getting stuck in this rent trap where they can only just afford to pay the rent and the bills, let alone go out and actually save for a deposit and buy a house, is very, very true. And that's the mass market. You think, oh yeah, the wealthy have sort of escaped this. The wealthy are sort of the wealthy are sitting pretty. The wealthy aren't. They're the ones that have been penalised through the Labour government so far. And it's not going to be news to you that they're now leaving in record amounts. The UK, middle of last year, was the second highest country in the world for millionaires leaving. At the end of 2025, the UK, by a country mile, is the number one country for millionaires to leave. The amount of people, it's over 1,000 millionaires a month are leaving the UK. And of course, they're going to the big, the big sex appeal, hot names. They're going to UAE, they're going to US, they're going to Singapore. They're going to these places where they're treated better. They're leaving UK in droves. And the likelihood is that's only going to increase. And the net return of that is not good for the UK economy. So it doesn't matter whether you're wealthy and getting taxed on what you're making, or you're in the mass market, which is the majority of people who are getting hit. The majority of people in the UK are being significantly hit by the economy, the politics, the most recent budget, a lot of the introduction of the tax systems, national insurance, minimum wage. All of that blended up shows a pretty dark picture for the UK economy. That said, it doesn't apply to everyone. A very small percentage of people do really, really well in the UK. And this is those who actually buy assets. Because at the same time, the majority of people, the mass market, the middle class, who've had to live in the dream for a decade, they're now feeling the pinch, and they have done for the last 5 years. The wealthy over the last 5 years have actually just done incredibly well. And this is because they own assets. If you look at what's happened to assets, in the same time that wage growth hasn't kept up with inflation, disposable income has gone down, quality of living has gone down, cost of living has gone up, tax has gone up, even basic well-being, happiness and health costs and average life expectancy in the UK, they've all gone down. At the same time that's happened for the majority of the population, a very small percentage have done really well. And these are the wealthy that own assets and bought assets. People who actually are property entrepreneur members, the people we teach, we coach, we mentor, those of you that listen to these podcasts, and me and my businesses. This is what we do. And over the last 5 years, whilst it's been sad to see everybody else struggle, and people keep saying to me, I am in danger of writing this narrative that the UK economy is on the way down. If it's that bad, why don't I leave and actually move to Dubai? The reason is, it's sad to say, it's sobering to say, the UK economy actually does really well for me. And over the last 5 years, while the majority of people have been going backwards, I've actually been going upwards significantly. And the reason for that is I own assets. So if you look at gold, I own gold. Lots of you will own gold. Gold has almost doubled in price. In fact, no, more than doubled. It's gone up 117% in the last 5 years. So if you just own gold, you haven't had to go to work or do deals or earn an income or run a business. You've just got more wealthy and your wealth has doubled in gold. S&P 500 that I invest in aggressively and do it month in, month out, year in, year out, regardless of what's happening. My S&P 500, which is a reasonable sizable part of my, in fact, it's the biggest part of my non-property asset portfolio, has doubled in value over 5 years. So I've made hundreds of thousands of pounds just from doing nothing by owning those assets. It's gone up nearly 100% over the last 5 years. If you look at property prices over the last 5 years have gone up 25%. For every £1 million of property you own, over the last 5 years, that's gone up £250,000. So you think that's £50,000 a year you've earned over the last 5 years from just owning £1 million worth of property. You scale that up to 5, 10, 20, 50, 100 million. That's gone up 25% in 5 years, again, from doing nothing. Not only has it gone up from a capital standpoint, it's also gone up from cash flow. Rents have now gone up 40% in the last 5 years. And if you follow the blueprints that we teach on Property Entrepreneur at our 3-day retreats, if you've not already secured a place for this year, we only host them 3 times a year. They sell out every single year. We ship people in from other hotels in minibuses because we physically can't get enough bedrooms at the venue. Go to www.theblueprintretreat.co.uk. Get yourself booked on for one of the events this year. The blueprints that we teach enable you to lock, say, your debt in for 5 years. So for the last 5 years, your mortgages have been locked and flatlined, but your rents have gone up 40%. So for every £100,000 you have in rent roll a year, which might sound like a lot of money, but it really isn't. We have 7-figure rent roll. Let's say you only had a 6-figure rent roll and it's gone up 40%. That means every year you've made an extra, every year now you're making an extra £40,000 a year in net cash flow just because the rents have gone up. Again, you haven't had to do a huge amount. Not only that, what your competition doing, because the mass market are running for the hills and a lot of people don't know where to turn, the vibe is pretty negative, the positivity is pretty low. What that means is you get low competition and high margins. If you look at for 2026, only 4% of your competition are looking at buying more. So only 4% of landlords are looking at buying more. 73% looking at staying the same. 20% are actually looking at leaving, and 3% say they haven't decided yet. So 95% of your competition aren't even competing with you this year. So 2026, if we're predicting what's going to happen for a buyer, for an investor, for a developer, those of us going out to buy more, competition is low and margins are high. Not only that, affordability is good. We've not had any issues, touch wood, over the last 12 months getting finance. And we've borrowed millions and millions of pounds. It's not been uncommon for us to do £1 to £3 million in a single month of either bridging finance, development finance, refinancing. Mortgage is available. Finance is available. The mortgage acceptances are going up and up and up. So there's finance available. And the volume of deals, again, if you look at the stats, units available per month, per agency, again, they're gradually creeping back up. And this all works really, really well for us. So for those of us in the UK that know how to play the game, we're doing incredibly well. But the reality is that's less than 5% of the population. Most people are running for the hills. They're having a reduced standard of living, and it's really not a great position to be. The problem this is going to create and has created is something that I actually predicted in 2020. I stood on stage in October 2020. There's a photo of me doing it. There's a video of me doing it. And I said, my prediction is post-pandemic, post-lockdown, because of quantitative easing, we're going to end up with record high inflation rates. And what that means is interest rates are going to spike, asset values are going to go up, which means the wealthier will get wealthy. As I've shared with you, that's exactly what happened. But the downside is the cost of living for the mass market, who've been the middle class for ages, is going to be squeezed, and they're going to really, really suffer. And this is exactly what's happened. What's happened is post-pandemic is created this wealth gap. And this wealth gap is getting bigger and bigger every year. Now, if you don't understand what to do and you're just sitting there going to work, earning your salary, just burying your head in the sand, I guarantee you it'll be death by a thousand cuts. You just look at how much your shopping costs every week now compared to what it was a year ago. You look at your mortgage, your utility bills, your cost of living is going up and up and up. You look at how many holidays you're having now against how many you had 5 years ago. Disposable income, money left in the bank, how much you're spending versus how much you're saving. The reality is over 95% of the population is going to be death by a thousand cuts. And this isn't going to stop anytime soon. But the solution is to actually beat the wealth gap. And when you understand these predictions, all of that I've shared with you is painting a picture as to where the UK economy is. I'm now going to share with you where we're going. And this is the reason why, because we want the solution for everybody. And this is what we focus every single one of our Property Entrepreneur members to achieve, is we want you to achieve a 7-figure net wealth with a 6-figure income outside of your pension and home mortgage, which means you're genuinely financially independent. And what that means is you'll beat the wealth gap because you will own assets. And what that means is every single month and year, you will get wealthier and wealthier and wealthier by doing nothing. And in the UK, that will fare you fantastically well. If you don't do that, you're going to be in the more than 95% of the population that's going to have death by a thousand cuts. If you look at the stats of the UK that sort of qualify this, again, this podcast is very steel heavy. It's very data heavy. It's just facts. I'm just painting you a picture with proven facts. If you look at the wealth distribution in the UK to see who is actually wealthy, and wealthy in the UK is a 7-figure net worth after your residential house and your pension, which gives you a minimum of a 6-figure annual income. If we look at the wealth based on just purely on 7-figure income, excluding the main home and pension, those who have under £250,000 net worth in the UK is the majority of the population. That's 86%. So 44 million people in the UK, 86% of the population have less than £250,000 net worth accumulated in their life. Now, when you understand what I understand and how easy and accessible it is to go out and build businesses, to make money and to buy assets, that's absolutely criminal. And this is what we work really hard on trying to change and trying to help. If you're in the category of 250,000 to £1 million, that's 13%. So another 7 million have less than £1 million in net worth. Only 350,000 people have net worth of over 1 million to 1.5, so that's 0.7%. 1.5 million to 5 million is 0.6%, that's 300,000 people. 5 million to 30 million is 0.06%, that's only 32,000 people. And in the UK, to have over 30 million in net assets, net worth, is 0.01%. The reality is only 1.8%, so let's say 1.5 to 1.8% of the UK are actually in that wealth category, which are getting wealthier and wealthier and wealthier. Over 98%, 98.5% of the UK have less than £1 million in net worth. We want to get you into that category where you've got £1 million net worth, you understand the model, you understand the market, and you can go out there and do deals and build businesses and actually get these margins. So what's actually going to happen in 2026? I've painted the picture. I've given you the stats. What does that look like in practice? Well, I'm going to take you through the inflation, interest rates, property prices, mortgage rates, PRS rents, and the GDP. And this is our prediction for what we expect will happen in 2026. And as it stands, this is the model that I'm basing all of my investment thesis in for 2020, for the 12 months ahead. And this is what I'll be doing my deals on based on what I understand as it stands at the moment. So we'll start off with inflation. I think because in the most recent budget in December, the Labour government decided to introduce more taxes and increase minimum wage further. Business rates are up and nobody really got the stimulus or the savings that were expected. I think the reality is inflation is going to stay higher for longer. But because things like utility bills are going to start dropping off and out of the register, I think it's actually going to start creeping down as we come into the spring. So I suspect through January, February, March, we'll see it balancing out and then starting to come down. And then well into the later months of the year, that will come down gradually. I don't think it's going to come down hugely aggressively. I don't think it's going to be down anywhere near the government's target in the 12 months ahead, but I suspect we'll probably go from, say, 4% gradually down to about 3%. Not going to break any records. I think it's going to be slow. I think it's going to be steady. But there's a number of other factors that are going to influence that. But I don't think it's going to be an aggressive drop. What does that mean for the key metrics that we care about? Well, interest rates is the next thing. What's going to happen with interest rates? Again, people were expecting big drops before Christmas. They're expecting between 1 and 1.5 to 2% drops in 2026. I'm just really not seeing that at all. Unless unemployment ticks up, unemployment's at 5% at the minute, which is very high, but some of that is because people have returned to the jobs market. However, post-budget, I do think there will be less recruitment. The vacancies are still at 1.5 million, which is healthy, but the unemployment rate is up. There is unemployment. And if retail, hospitality, leisure, post-Christmas do stop recruiting and even downsizing, unemployment could go up. And if it does go up, I think we'll see a more aggressive drop in interest rates to get people spending. However, if GDP stays steady and inflation is steady and not aggressively coming down, I don't think we're going to see an aggressive drop in interest rates. My prediction for 2026 is a maximum of 0.5% drop in interest rates, as long as inflation doesn't drop aggressively, which I don't think it will, and unemployment doesn't rise aggressively, which I think it might creep up, but I don't think it will rise. So on that basis, I think we're going to see a 0.5% interest rate drop through the year. So really, is there going to be any significant drop in mortgage rates? We'll talk about that in a moment. At base rate, I don't think there's going to be a big drop. Mortgage rates, what does that mean for your lending? Well, I think the good thing is we're now starting to see a steady economy. So whilst last year was all about driving in the fog and sort of playing the short game, getting in and out pretty quick, what I think you're going to see in 2026 is a bit more clarity and confidence. Now, I'll talk about GDP in a minute. I don't think that necessarily means everyone's going to be out the traps going a million miles an hour. I think what it means is it's going to be a little more clarity. And because of that clarity, I think the mortgage lenders are going to start competing and they want to get money out of the door. And they're just going to do it on the basis that they know rates are going to be steady and slowly coming down. And at the minute, longer term fixes, or for the last year or so, 5-year fixes have actually been more expensive than 2-year fixes because you're paying an insurance policy for security. I think actually, and this is a real key important metric, is if long-term rates are cheaper than short-term rates, what it means is they're pricing in a drop over the medium term. And whilst last year was driving in the fog and you couldn't guess what was going to happen, I think now, although it's not hugely exciting or stimulating for the economy, I think actually the clarity of what's going to happen is now quite clear. People will start pricing those discounts into the longer terms. And I think mortgage rates will start to come down steadily in line with interest rates as they come down. And there'll be more competition into the spring market for lenders who want to get money out of the door. So mortgage rates will start to slowly come down in line with interest rates, but nothing aggressive. If you've got some refinances going on, it's always worth sort of looking at what's coming up, when the Bank of England announcements are going to be. And if you can time it loosely around maybe waiting for a key drop to get that price drop with the lenders, that could be worthwhile. But because it's so slow and steady, what you're finding in the main is a lot of lenders are actually pricing in the next rate drop. So at the minute, people have already priced in a December, January drop for the January sort of quarter for lending. So we're seeing it come down, but it's slow and steady. It's not going to change the world, but if you're refinancing onto 5-year fixes, if you can just get that extra 0.25 drop or 0.5 drop, go with a lender who's being a little bit more bullish because they want to win the work and they've got money they need to get out of the door. Those little wins when you're doing enough deals can be quite significant. Next is property prices. What's going to happen? The general vibe seems to be the property market is going to be flat and it's going to sort of slow, if not start to drop. I genuinely don't see that being the case. I think pre-budget, that sort of froze everything for about 8 to 12 weeks. You then got the Christmas and New Year market, which sort of slows everything down. But then into January, you've got this sort of you've got the new year, new me, new year, new me, or new year, new you. People going out, New Year's resolutions. Let's look at new houses. Let's start the new year the way it means to go on. You've also then got pent up demand from the pre-budget and Christmas quarter, if you like. I think that will push the market into activity. You've also got the government or Bank of England finance policy changing around relaxing affordability loans that were brought in post-global financial crisis. So that's introducing more flexibility for some of the areas of the market, the elder generation and first-time buyers who perhaps haven't had the affordability or the access to finance that they've needed. So I think based on that, into the new year, the property market is actually going to stay growing at a good steady sort of 2 or 3%. I actually think it will increase towards the 3% growth year on year, and it might even go higher out of the winter and into the spring market. Just because I think demand exceeds supply. I think there's liquidity, there's affordability, there's increasing affordability, and there's a bit of pent up demand pre-Christmas. I think that means that property prices will grow this year. If it doesn't happen, I think the government will actually intervene. I think if the market does slow, because it's such a key part of the economy, I think property market transactions is everything from surveyors, trades, solicitors, agents, lettings, everything, mortgage brokers, finance, banks, lending, all of it. It's a huge part of the economy. If it doesn't get going again, I think there'll be some stimulus from the government to get it going, but I don't think it will need it, in which case I think, I just think it's going to gradually tick up this year and property prices will continue to go and probably end the year somewhere between 3% conservatively, potentially even more year on year. So I think that's good for business. Rents is an interesting one. So last year I said I think rents are going to go through the roof, and they absolutely did. For two reasons, I think you actually need to be quite careful this year. The first reason is demand and supply, and the second is the Renters' Right Act. So I think what's going to happen based on demand continues to exceed supply. And then the Renters' Right Act, two things. One is going to continue to reduce supply. I think people are going to still not go into the market because being a landlord is seen as risky. It's seen as hard work. It's now getting expensive. There's more tax on it. There's lots of reasons why people are going to leave the market. Those who are in the market not grow in the market. And actually those who would have previously entered the market not enter the market. I think the pressure on supply is going to go down. At the same time that every year, more and more people demand is going to go up. People are going to leave university every year, leave home every year, get to an adult life every year, get divorced every year. Every year, more people move into the rental sector. So I think demand is actually going to go up. I think supply is going to go down, which means rent is going to continue to increase. The big difference, I think, this year against last year's prediction that came true is I think what's going to actually happen now is going to hit an affordability ceiling. Now, in the Renters' Right Act, it says that you can no longer do bidding wars on rents. Now, what this means is you rent an apartment you list it at £700 a month. And then you have 5 people go for it. You have 725, 750. And it's just forced rents up and up and up. People have just bidded the market up. That's actually banned now. It's going to be illegal under the Renters' Right Act to allow you to take any rent that's higher than what you listed at. Now, anyone who's remotely savvy is going to know that the thing to do here is to list then 10 or 15 or 20% above what you expect to get and then allow people to negotiate down. So if you can't take £1 above, but you can take 15% below, everyone's going to list it above. And eventually that's just going to force the market up again. It's going to push it to the highest level. The opportunity here is rents will continue to grow. But the risk here is that as rents grow to a point where they're no longer affordable, actually people start to fall into arrears. You start to get bad debt. People can't actually pay the rent. And because now they've got to be 3 months in arrears before you can start the eviction process, and the eviction process is longer winded, it could genuinely take you could lose definitely 6, quite possibly 12, and even up to 18 months of no rent from taking the wrong tenant who convinces you they can afford a rent. They then fall into rent arrears. And if they decide not to move out willingly, you will end up with a sitting tenant. So actually, I think rents are going to hit a glass ceiling. Those who keep increasing rents are actually going to catch a cold and end up with bad tenants that could cause 3 to 6 months, definitely, even up to 18 months of arrears. And I now wouldn't be focusing on getting the highest rent and pushing rents really, really high. I would actually focus on what we call value for money. So I'd be looking for tenants who've got really solid guarantor, can pay the deposit as well, have got maybe two incomes, rather than the rent is going to be 30% of their monthly income, it could be more like 20% or 10%. Just go for that really high affordability ratio and get the balance of who can pay the best rent with the best security. And that's going to be really important for the year ahead. So that's rents. I think they'll continue to go up. Demand exceeds supply. And ultimately, the landlord always wins. Yes, there's more regulation. Yes, it's going to be harder to do certain things. Yes, possession orders are going to be more challenging and more specific. But as a landlord, investor, as long as you understand these things and you play the game and increase your compliance, you pivot where necessary, you adopt your strategy effectively, which is literally what I personally mentor all of our property entrepreneur members on every month on how to actually deal with this stuff. The outcome is net positive, but you've got to understand how to play the game and align with all the new criteria, legislation and regulation. So that's rents. What does that mean for GDP to finish off? What's going to happen to GDP and the economy? The reality is, I think the UK is just going to stumble along. I don't think there's going to be a big drop unless we have a black swan. If we do have a black swan, I think it'll be because of either global debt or it'll be an AI bubble. I won't share the detail on that now, but I did for our members last month show all of the data as to why I think they are real risks. So you've got to be prepared for that. But outside of that, I think GDP is just going to tick along. I think 1 month it'll be up 0.1, another month it'll be down 0.1, then it'll be up 0.2, then it'll be down 0.2. It's not really going to go anywhere. It's just going to flatline. And I think the reality now is what we didn't know a year ago, which is why we were driving in the fog. I think what we now know is the Labour government have got quite a socialist style agenda. They're still spending. They're not really doing a huge amount of saving. There's next to no stimulus. I think what's going to happen is the UK economy is going to be like this big train, just big reliable steam chain, chugging along. It's reliable, it's resilient, it will keep going. It's not going to be a big drop, it's not going to be a big spike, it's just going to chug along. And most people are going to run for the hills. Most people are going to read the newspaper, they're going to get distracted, they're going to think all this bad news about the economy, the politics, all of this stuff is going to scare them off. And the opportunity for you is this means low competition and high margins. When I look at the margins that were available last year from understanding how this market model works, they were phenomenal. We were making 100,000, 200,000. Listen to some of other podcast episodes I've released in recent weeks. We've been making 100 to £1 million per deal, per portfolio, some of it in as little as 60 days because there is no competition. The closing sentiment for the predictions this year is there is going to be nobody competing with you. Investors are running from the hills. The news is bad. The outlook is negative. Nobody's getting hugely excited about a booming property market. Everything says UK, unemployment's going up. People are losing their jobs. Cost of living is going up. Disposable income is going down. Quality of lifestyle is poor. The UK economy is terrible. The Labour government are losing control. Keir Starmer is going to be overthrown by some power struggle from his backbenchers. All of this bad news and press is probably what we're going to have till the end of the Labour government, unless something significant changes. So for the year ahead, I would be predicting that you're going to have low competition and high margin. I would say it's going to be a buyer's market if you know where to look. I would say the deals that we would have loved to do 3 or 5 years ago, but we couldn't because it was all hot market, loads of competition, we can now buy them in droves because there's no one competing with us. I think the closing sentiment is the margins are huge, the competition is low, and when you understand play the game, this year, without question, is the best year that I've seen since the pandemic to go and do deals. In the pandemic, we made £1.9 million of extra profit in the first 12 months by using this model. And in the second, we made 3.4 million. So in the 2 years of COVID, we made over 5 million. Last year, through our businesses and deals, we made over £4 million in net profit by understanding the prediction of the market, observing the masses doing the opposite and finding these little niches where you can go and do deals. And this is the opportunity for you. So if you're encouraged by this, we want you to be bold. We want you to be brave. We don't want you to be foolish, but you do need to understand how to do deals. And if you're serious about stepping up, you've listened to these 2026 property market predictions, and you want to take action and move forward, click in the show notes now. We're going to do a live webinar where we're going to do the top 3 deal strategies. I'm going to do it live. I'm going to do it completely free of charge. I'm only going to do it once. The link is in the show notes. Click it now and get yourself registered. And on here, I will take you through, based on these market predictions, the top 3 deal strategies that I would recommend for 2026. I will show you that I've done them, I'm doing them, and I'll share with you why I recommend them and how you can do the same. And if you want to make a 7-figure net worth or a 6-figure income in 2026, these are the strategies you need. And when you understand how to do them in practice, you will see from a single deal alone, it is very realistic in the current market to make 100,000, 200,000, 500,000 pounds in a deal that can take you less than 90 days. And if you stretch that out to 6 months, you can genuinely make multiple 6, if not 7-figure plus equity gains with consistent 5-year, 3-year, 6-figure and multiple 6-figure annual incomes just by understanding the market and these models. So I hope you've enjoyed that. Click the link in the show notes now and subscribe to the top 3 deal strategies for 2026. This is going to be the second part of our 2026 property market predictions. I hope you enjoy this. I'm very excited for 2026. It's the best market and economy I've seen since the pandemic. And when you understand that observe the masses and do the opposite, bad news in the press is great news for us as long as you don't get seduced by the headlines. Success and failure with this stuff are very, very predictable. Click the link in the show notes now. Join us and I'll teach you the top 3 deal strategies for 2026. And if you want to hear some of the deals I did last year, listen to the Deals podcast whilst you're waiting for the live webinar for next year. And I talk about my top deals that I did in 2025. That was released on the 1st of January. And listen to some of the other recent podcast episodes I've released about the deals I've done. And make sure you click subscribe now on whichever platform you're listening to this. Share this podcast with your friends, your family, the WhatsApp groups that you're in, and follow us across all platforms for live updates through 2026 on how to achieve genuine financial independence, a 7-figure worth and a 6-figure income by going out there, buying assets, doing deals, and making this happen. Success and failure are both very predictable. I wish you the very best of luck for investing in 2026.